Welcome back, guys, to another stock market update here. Right now, we had some quite interesting price action over the past week, and I see a lot of people are calling for the top here of the stock market before they will continue lower. But I wanted to share my thoughts overall because I still do believe the stock market has to be propped up much higher before we'll get the World War III and then the major crash. World War III we can discuss a bit in another video. This might not happen or not as dramatic as we believe it, but somehow when it's going to be explained, the major crash we're going to have to the downside. As I've been talking about, this stock market has been very leveraged in my opinion, and we need to get a massive correction. This is not normal behavior. The economy is going to basically down the drain while the stock market is continuing going higher. We need to correct this entire move. Also, the amount of money that has been printed and has been sucked into the stock market is beyond belief, and this is not sustainable in my opinion. So we are gonna need a major crash, and we need to finish this super cycle that we've been starting down here 2009. We have this as a massive 1, 2, 3, 4, and right now we're in the ends of the final Elliott wave, fifth wave, which is gonna complete the super cycle. So then we can expect, at least I would say from this median, at least a 30% correction, easily 30% minimum. But I do think these COVID lows are easily achievable, which is going to be around 70%. So those who have been following me, you know we have this median line here. This is the world's largest pitchfork, and the way it works is algorithms are sitting up here waiting to sell. And in my opinion, the stock market cannot fall. We might have a drop here, but we need first to hit this median line before we continue lower. Right now, we had a bit of a correction here, which we can see here on my Twitter. We actually posted it back here in April 16. So we had this from the second wave up to the third wave, and this is also the monthly time frame. So we had the 0.31 Fibonacci here we touched, and we're expecting a smaller time frame fifth wave here to complete at the minus 0.236, which we can see here. Let me just readjust this Fib tool. So we had here from the second wave to the third wave if you come here on the normal scale. And as we can see here, let me just readjust this one here to the second wave. So we can see here the stock market hit the minus 0.236. As you guys know, I'm not a big fan of Fibonacci tools. These two are the only ones I use. I personally back tested them. And these work on every time frame almost. So right now we have completed a smaller time frame fifth wave here. So we had this as a 1, 2, 3, 4. So this was a smaller time frame. Then we had again here at 1, 2, 3, 4, and then a fifth wave. And then of course we have the super cycle. So let's change color. We can make this red. But then we have the macro fifth wave, which has not reached. We need to reach the pitchfork before then. So right now we can expect some sideways. So either the stock market is going to correct in time. So either we might get some chop here before we continue higher, or it's going to correct in price, have a one impulsive move down, and then continue higher. So just something to keep in mind. We can see the same pattern as I spoke in my previous video played out here during COVID. So this is something I posted in my old Twitter account. So we can see here. I think I covered this in my last video just to do this. We can see here again the algorithms from the second wave here to the fourth wave that we had. They start buying at the 0.31, and of course it's just a coincidence, I guess, that the big algorithms or the big entities that are controlling the algorithms got out in time right before the COVID crash. I mean, probably just a coincidence, right? Because these markets are not rigged, I guess. But yes, so this is my outlook for now. Let me just pull up the pitchfork again. I see a lot of people here are still calling for lower prices, but in my opinion, we're still gonna go much higher. We have this pitchfork. Let me just try it again. From 1974 up to 2000, and then to the 2009 crash that we have here. So this is basically the pitchfork. So we're aiming around 8,000 for this SPY. Let me just readjust it so we can get it properly. It's important to use the magnet tool because you want to use accurate price data. So yeah, so in my opinion, we still have higher to go. We want to long any dips here. You can see here back in 2022, we came quite close to the median line, but we haven't yet reached it. We can add some more lines here on the stock market. So we can see here, we can use these levels as different support and resistance. So for now, we have bounced from the 0.31. So we pulled from the lows down here to the highs. So we said this is a potential 1, 2, 1, 2, 3, 4, and then we're going to continue higher. So we had this as a 1, 2, 1, 2 wave here, 3, 4, and right now we're going to continue higher. Of course, we can still go down and make a second low. In that case, we'll just pull here from the other second wave here to the third wave. So if we break down, the next area we look to long is at 4,997 for the SPY. But overall, right now, it looks like we have made some quite strong bottom here. But usually, something we need to keep in mind is fourth waves like to go sideways. So I wouldn't be surprised if the stock market stabilizes here a bit before then we get the final rally here, which is gonna go until next year, is my guess. Of course, as I said, it's very hard to predict time, but we can predict price. So depending the longer it takes, if we're gonna reach it 2026, that would mean from current prices another 42% gain for the stock market in less than 1.5 years, which I do believe is doable because the final fifth waves usually are the most impulsive ones to the upside. But you really want to be buying any dip here, in my personal opinion, because I still do believe they're not going to let this market crash before the algorithms get out of the market. And as we can see here, since 2009, the algorithms have been long this entire market. We can see price has been pushing. We almost came closer to the median. We came down here, but they keep pushing the market until the big algorithms get their final target reached. Then they're going to start dumping, and that's when we're going to get the crash. So it's not the time to be bearish here. Also, something I want to mention is here on the Nasdaq. So we have similar pattern on the weekly on the Nasdaq. That's also a reason why we had this crash from the stock market. We can see here in the Discord, we called it on July 11th. We can see here Nasdaq reached the median line. We said here time to send it lower, and that's exactly what has happened. So these pitchforks are actually to be respected. We can see this on the weekly time frame. So since we hit the median line here, the Nasdaq had actually dropped 16%. So can kind of get to find idea the amount of selling pressure these algorithms have behind them. Of the S&P, I can't imagine what's going to happen once we reach this on the monthly time frame, this pitchfork. That's why I think at least a 50% correction we can see, and then probably something like a multi-year bear market going sideways before then the stock market can recover and we can start making new highs. I'm guessing something that we did back here in 2000 and 2000, between 2009, basically the stock market didn't do for almost 9 years. Basically we didn't do much. Like we went down and up again, but overall the gains were not much to be made in 12 years if you start from 2012. So if you bought the top in 2000, basically 2012 you were still in the negative from holding the stock market. So these corrections can be really deep. So just something good to be prepared, especially even if you're a long-term investor. So you're thinking buying here and holding. Personally, I'm not looking to hold. I am looking to sell once we get here, and then I'll reconsider again at the bottom. Also, if we look at the 10-year yield, something I want to cover, the 10-year yield is actually the most important chart we have to look at. As long as we can keep the 10-year yield down, basically when the Fed is buying the debt, that's usually when the 10-year yield drops. So they're going to try to keep it pushed down as much as possible. We can see here with the markets crash, the 10-year yield crashed as well quite a lot. And as long as we can keep the 10-year yield down, that's going to be a bullish sign for the stock market. We're still stabilizing here on the daily time frame on the 10-year yield, but overall this is a very bullish signal that we had such a big drop here on the 10-year yield. I believe once we're going to see the real top form on the stock market and we can start expecting a final blow of top, that's when we're going to see the 10-year yield spiking. The higher 10-year yield, the more risk there is to be long in the stock market. But overall, I see too many top callers. Be careful, guys. They don't understand this is a managed market. We're going to go higher. Right now, we have found support. So I'm looking to long any pullbacks here. If we go lower, as I said, we'll just pull here from this wave to the third wave. So either the bottom is in here at 5,100 or the next support is going to be 4,900. And that's going to set up a really nice long position here, which you can then ride probably till half of next year. I'm guessing close to 2026, maybe in May 2025 it's probably be the top, something like this. I'm guessing this would look to me quite realistic, but as we said, time is hard to predict. This could go all the way up until 2026 before we get any major recession. Otherwise, thanks so much for watching. You can check my Discord down below if you're interested to come and chat with me. Otherwise, I'll see you again, guys, in the next video.